one of the things you learn about housing is it's not a stock, it's not crypto. It should be not something you're getting into for a day, a week, a month, even a year, right? There's all these transaction costs and variabilities, right? If you're getting into your home, conservative, plan to live there a decade, it's hard to go wrong when you look at history. Earlier today, we learned that 45% of homeowners regret buying their home. To that end, I'm also hearing from more and more investors who are getting their ass handed to them because they bought a bad deal at a bad price with bad terms. We're going to talk about all of this and more with Jonathan from Convoy Home Loans. We'll also talk about inflation, bridge loans, and much, much more. But let's just start with people regretting their decisions. Jonathan, what do you got? You got some practical advice in all of this?
Yeah, I mean, we've been doing a lot of previous client outreach, right? And going through the books and the motion. And obviously, a lot of our clients, we're seeing a huge difference, right? The people that stretched very, very thin, that we told them, hey, this probably isn't going to be the best deal for you, right? And then the people that are like buying with good margins, good profits, good cash flow, two separate classes. Like you said, I think in the video, 45%. I think the number one thing that people forget is after you put the down payment and let's say closing cost to purchase the property, they always forget for some reason about how expensive it is to maintain the house, just to maintain it, right? The electricity, utilities, something breaks, you have to fix it, right? If you're an investor, right, and your tenant leaves, and I've been hearing this the most because now it's been like a year or 2 years. New tenants are moving in, previous tenants are leaving. The cycle of tenants, right? The cost of capital that goes into cycling the unit so it's tenant ready again has kind of been the biggest, I think, crux for a lot of investors that they haven't factored in. They factored in utilities, they factored in expenses, they factored in this vacancies. They did not factor in that it's going to cost, if the tenant messed up the property, $5,000 to $10,000 potentially to just fix the unit to make it ready again. So now you're backwards on all the money you made on the rents just because you bought it at such a tight margin.
Yeah, one of the things that's really funny to me, having done this for a long time, is it's amazing to me, homeowner or investor, that you just miss some of the costs. Like the article Bankrate talked about homeowners. We'll go to investors in a minute. Not understanding property taxes. I'm like, are you freaking kidding me? You don't understand property taxes? All right. Or like they even talked about internet cost and like water and garbage. I'm like, folks, this is not okay. You're an adult, right? You should know that homes come with these costs. And no, by the way, to your point, maintenance as well. Water heaters break. Oh my God, you got to mow your grass if you have lucky enough to have grass. I mean, it's mind numbing to me that people don't understand what all comes with owning a home. To that end, as you said and I said this morning, take this as a lesson. If you're out there shopping for a home today, just pretend for a moment it's your first time home. Do not stretch yourself. Jonathan, I can only imagine the number of phone calls you get from somebody looking to buy their first home. They probably always ask you, how much can I qualify for? Like, what's the pinnacle? What's the most? And then they hear 650. They shop for 650. Just because you can doesn't mean you should. I think that's where a lot of people go wrong.
I think, and this is, I guess, what really sets us apart that I've seen from other, mortgage brokers and lenders is we'll tell clients two things. We'll tell them, hey, this is the max, right? At 50% debt to income ratio, this is your max. However, I know for a fact that if you're W-2 or salary or wherever, you're not taking home that 50% debt to income ratio max. So what are you actually taking home, which is going to be probably 40% less than whatever is on that W-2. And then let's calculate where your max is actually from that payment, not from the 50% ratio. Because, and I've lost business this way. Because
I'm sure you have.
People will go to another lender and be like, oh, Jonathan only approved me for, 400,000 when I could apply and get 600. So I'm going to go buy that 600 home. Screw Jonathan. He messed me up. And they missed the factor of me telling him, hey, the reason I'm telling you not to go for the 600 is because I want you to be prepared and have reserves just in case something happens for the extra money. Because once you buy it, we've talked about this so many times, buying is the only point in real estate that you either make or lose money, right?
Correct.
You make or lose money, everything in the buying aspect. And when they go 50% debt to income ratio, max out everything, max out that, you're going to be underwater. Give it, a few years or less, and you'll be underwater. Those are probably the people that are unhappy with buying their home. Anyone that bought within their means, below their means, or at their means, like at their actual means, is not unhappy.
No, totally agree. Yeah, the other thing you got to realize is one of the things you learn about housing is it's not a stock, it's not crypto. It should be not something you're getting into for a day, a week, a month, even a year, right? There's all these transaction costs and variabilities, right? If you're getting into your home conservative, plan to live there a decade, it's hard to go wrong when you look at history. But now let's go to investors. I am so glad I have receipts. 6 months ago, Jason Pritchard, Adrian Hernandez, Omar, I'm telling all of them, change your buying criteria. The market is about to go against you. The ARVs that you guys have today are wrong. You need to plan for an extra 60, 90 days of holding costs. I told them. And some of them listened, some of them didn't. And if you didn't change your operating model as a home flipper, which is buying and selling 6 months ago, you are sitting on inventory you can't sell with very bad terms. And there's one guy that went out and bought 40 homes in SoCal. There's a very good chance that person goes bankrupt.
Yeah.
So again, investors, you guys, you're always, investors for whatever reason, always look backwards. What happened? What worked? Let's do more of that. Instead of looking forward like I do and giving you warnings to buy deeper, double your hold time. And there are going to be plenty of investors just like Q1 of 2022 that lost their ass. And this could be worse.
I think it will be worse because back then, I don't think the terms in terms of LTVs and that people were writing were as aggressive, right?
Correct.
That was
True.
a little more of an unstable market where we were seeing, ups and downs a little more. So lenders were a little more conservative, but now, right, we're back to, I'm seeing some loans that I'm losing at, people are writing 95% loan to value, 90% loan to cost, all that stuff. And I'm like, you're a first time investor. And this is where I think you've never renovated, flipped, or done a project before, and you're telling me that you want to max out every dollar you have to be at 10% down, to buy this thing that literally, if you're buying it wrong, but if you flip it and it's wrong, then you are going to be underwater and you're going to be losing more money than you would have had to put in. Like, are you prepared for that? And obviously people don't want to hear it, right? That's not something.
I'm so glad you're a part of this channel because I frankly want you to tell no to those people. You don't want to be on the hook for a deal that goes bad. It's just not a good environment. Well, let's get off these investors and homeowners because there's lots of regret out there. You got to buy right. You got to be conservative, hold for a decade. But let's talk about the biggest news probably in mortgage, and that's inflation. Inflation, PPI, CPI, all came in better than expected. 10-year note going from 4.5 to 4.3 something in the last week or so. What's going on with mortgage rates? What's going on with all that?
I mean, rates are obviously, we've seen a pretty big swing down from, the 5th to today. I think we were talking about like 4.36 something versus a 4.5, right? That's a pretty big swing in a week. However, I think there's two sides of it. The non-QM market, the non-conventional market is kind of used to these swings now, right? Yeah. So they're not flipping up and down, going back and forth. The conventional side, obviously, per usual, is flipping back and forth, and if you're a conventional buyer, right, and you're trying to explore conventional options, then you want to be in the market to be able to lock in times like this, right? When the rates do this, because just as fast as it came down, as we've seen, it goes right back up, right? And it just takes one comment from Trump, or it takes one comment from anyone else, right? That talks about trade or anything like that. And all of a sudden you'll see it flip the other way around. Bonds will start going back up. Everyone's going to be pessimistic again. And I think people just have too short of a term memory right now in terms of the way that they're looking at things, right? They're, instead of looking at it from a year-on-year basis, I think most people right now are looking at it from a week-on-week, and some people day by day.
Yeah.
And if your viewpoint is day by day, then you need to stretch it to, you know, at least a month. If your
Yeah.
viewpoint is a month, you need to stretch it to at least a year. Because truthfully, if you look at the market, and this is what we talked about, the last 2 years, right? Mortgage rates over the last 2 years on average is pretty flat.
Yeah.
It hasn't really moved that much up, and it hasn't moved that much down. And with inflation data coming in lower, with, you know, I think the trade talks kind of talking itself out and doing all that, you know, do we still think that rates are going to shoot down to the point where you can continue to wait and just sit on the sideline and see if things will happen? I mean, I could be wrong, but I don't think,
Maybe.
I
Yeah.
mean, yeah, it could be wrong, but, you know, I don't think that rates are really going to be shooting down that far, because as we've seen, the bond market does not like, and you've spoken about this a lot, the bond market does not like when Trump does these moves, right?
Mm-mm. Yeah.
And especially with the Fed chair, and if something happens there, then do we really think that even if, let's say, the Fed chair gets replaced, do mortgage rates actually shoot down that follow more of the bonds? Yeah.
No, yeah, there's a lot in that. It's going to be really interesting because not only did CPI and PPI came out better than expected, you know, now you have President Trump just today calling Jerome Powell, I think it's a numbskull, is his latest call. So it'll be very interesting. I think one thing we talked about earlier in the week on the Daily Financial News is, I think something that's very likely in the next 30 days is Trump nominates what will be called as a shadow Fed president, right? And what does that mean? So Powell's term as Fed chair ends May of 2026. I think Trump is so pissed off with Powell, right? Trump wants 100 basis point cut now, right? He wants him a full 100, a full point now. So I think what he's going to do is he's going to nominate somebody like, I think it's Kevin Warsh or something. And all they're going to do is parade around TV, making Jerome Powell's job very uncomfortable. So I am concerned about how the bond vigilantes are going to react to a shadow Fed president, because you may get an unintended consequence. It may go the other direction, to your point. What do you think?
Yeah, absolutely. And we've seen that despite Feds cutting mortgage rates can still go up, right?
Yes.
So Federal Reserve rate, the cost of capital on that side is not the cost of capital for mortgages, right? And so
Correct.
what we might see, and what I'm telling clients now, the tune's changed. You know, anyone that was thinking like, hey, maybe we can wait towards the end of the year to cash out or refinance or do this or do that, I'm like, hey, look, if you have a better use for the capital now, if you're doing the work right now, just lock it in and forget about it. Because you're going to be so worried about this other stuff going on that you're going to be unable to do the investments that are going to make you more than 6.5% on your investment, right? Which is on average where DSCR loan cash out, like if you're in a good LTV, is like 6.5 to 6.75. If you can make more than 6.5 to 6.75 on average with the money that you pull out, you might as well just lock it and then do the work to find something that's opportunistic right now versus later when, you know, just the head, I can already imagine the headline is, you know, Fed drops rate by 100 basis points. And then we get flooded. Every mortgage person gets flooded with calls. Our rates down, our rates down, our rates down. And then we're going to tell them, sorry, rates are down. They're up.
Rates went up. Exactly. Yeah. What happened?
Same conversation that we had at the beginning of the year when they were, you know, we were talking about, oh, they cut rates, our rates down. And we're like, no, rates are actually up, right? And so this is the same story, broken record, playing over and over again. And eventually you want and I want people to learn that it's not the most important thing for you to figure out what the rate is at that moment in time. It's what's on the table right now. Do the work based on that. Buy the properties with the right margins, buy the properties with the right cash flow, if that's your goal. And then make sure that that's what you're living in. Don't go outside of that just because the market's shifting left or right.
Couldn't agree more. One thing you said kind of pre-roll is that bridge loan activity is up, which I got to ask why. Again, bridge loans, first off, define what a bridge loan is, because maybe not many people don't know what that is, but I'd be curious why bridge loans are up in this environment.
Yeah, bridge loans are short-term loans, right? So anywhere between 6 to 12 to 24 months.
Okay.
They're used to buy properties that are subpar or properties that are needing work, right? To be able to get stabilized, that won't pass a conventional or a normal appraisal. Um,
Got
and
it.
we've seen an increase in that because I think it's a mental shift because people are seeing prices come down. I think people are being like, okay, homes are getting cheap right now. Maybe I can go in more aggressively and buy it on a bridge loan to do the work and then flip it right
Yeah,
into a
you know what I think's happening? Because again, I think this whole story about inventory being up 50% is accurate, but what I think people are missing is what we're seeing is the people who have to sell and the people who have to sell with what I'll call dog properties. They don't have any options, right? They got to sell for a deep, deep discount, preferably cash. In this case, a bridge loan, and that's really the stuff that's transacting, right? If it's a clean and clear, below the median property, it goes FHA. But if it's a distressed seller in a bad situation, it's going to go cash or bridge. So people are getting big discounts. I think that's what that tells me.
yeah. But my concern is obviously like you were talking about on ARVs and such, right? The market is
Yeah.
shifting so much. If you're not baking in a big enough margin on when
Yeah.
you're buying it, right?
Double your holding cost, slash the A. Because again, I warn people 6 months, like flippers. I know lots of them, like, guys, you're buying wrong. You're buying wrong. You don't realize what's going on underneath the surface. So I agree with you, right? If somebody comes to you for a bridge loan because they got a 10% discount, not enough, people.
Yeah.
Not enough. Get aggressive.
Yeah. I think rule of thumb, if you guys are, this is what I like to use, and I know a lot of other professional clients that like to use it, is rule of thumb that the margin that you want to build in is 30%. I think. I think
Yeah.
30% gives you some comfort, 30% gives you an out, right? Refinance, or, if you have to hold it for longer or you have to sell it at a little bit of a discount, you still make money. But the way that you calculate that is you do the purchase price plus the rehab budget, because typically you get the loan for both, right? And that's your total cost. And then you multiply that total cost by whatever loan to cost your lender tells you, typically 85%. And that loan amount should give you, like, basically versus your ARV, you should be at least a 65% loan to value to the ARV. Because
Yeah, and I'll
that,
give you one. Yeah, I'll give
yeah,
you one more piece. Double your hold time. That's what I think is going to burn a lot of people. Is their hold times were last year, 90 days or less. They're going to be 6 to 8 months in this environment. And again, that register doesn't stop ringing. Every month it comes back for a little bit more meat and a little bit more pain. So please double, like, in your hold time, double it, which means a lot more interest you'll be paying. And if you sell it fast, congrats, you made more money.
yeah, exactly. And be really careful and do the work on the markets, right? I'm seeing
Yes.
what's crazy is obviously there's a lot of markets in LA, right? And I'm seeing all these luxury homes sit for long times. Like these our clients that are holding on to 10, 15 million, $20 million
Woo!
are not selling, right? Luckily they are well financially equipped to be able to hold, so that's fine. But where I'm seeing craziness is like markets like, call it Manhattan Beach or South Pasadena, or these markets where like people want to live in and there's less inventory. Um, People are still overbidding, right? In
Wow.
these pockets of the market, right? People are in Manhattan Beach. We're doing a deal right now. It was listed for 175, went under contract for 2.02, right?
Oh, Jesus.
South Pasadena was listed for 1.8, went under contract for 2.2. So like, and the appraiser coming back, obviously appraisers usually match it, but like this is like, it depends on what market you're in. But if you are an opportunity seeker that's not planning to live there for a while, you probably should stay out of that race,
Oh,
because
yeah. Be careful.
you are not racing against people that are going to live there, as primary owners for a long
Yeah.
period of time. It should not be your base.
Yeah. Love
Yeah.
that. Jonathan, where can people reach out, get a process started with you?
Go to convoyhomeloans.com and let us know you came from ORaaT.
Yep. Let them know came from ORaaT, or they can email you. Yeah.
email us at info@convoyhomeloans.com.
Yep, that's easier. Some people can't find the button. So info@convoyhomeloans.com. Again, why do you want to do that? So you talk to this fine gentleman, not somebody in a cubicle. You want to talk to the man. He's the man. Later.
Bye.